Hello everyone. Today we'll discuss about one of the very important concept in the mutual fund, which is called net asset value, in common language called NAV or NAV. It's a very important element because the entire valuation of mutual fund scheme is based upon NAV. So in this video, we'll discuss about what NAV is and how it is calculated. Now, NAV is a price which at which an individual unit of mutual fund unit can be bought or sold. So, at what price I am buying a single unit and at what price I am selling a single unit, that is referred as NAV or net asset value of that scheme. Now, how is it calculated? You compute the entire net asset of that scheme on that given day and you divide by the number of units which are there on that day, and that will give you in how the NAV is computed. So if I look at the formula for this, NAV is nothing. You compute all the market value of the investment on that given day and you deduct the expenses which are outstanding on that given day. So this becomes, the numerator becomes the net asset and net AUM, and you divide this by number of units outstanding on that given day. That will give you the NAV. Now, what do you mean by market value of all the investment? It includes all the stocks, the value of the stock on that day, the value of the bonds if there are the schemes in that day, the total cash which you have, any income which you are about to accrue. So, for example, the fund manager might have invested in some bonds where some interest is accrued. He must have invested in some shares where some dividend income is accrued. So, all that adds up to the market value of all the investments, and then you deduct all the expenses. Now, expenses, what are the expenses which are there? So it can be fund management fees, all the expenses which the AMC is incurring, and plus the schemes or mutual funds are also allowed to take a short-term loan, so those liabilities are also included in this expenses. And then you find what is called as a net AUM, which is a numerator. But obvious, this has to be divided by the number of outstanding units, because eventually this money belongs to whom? This money belongs to the unit holders. So you divide the entire asset, net asset, by the units which are outstanding, and those are referred as a NAV of the scheme. And this NAV is calculated on daily basis because the market value of investment will fluctuate on daily basis. So whenever the market is open, whatever days the markets are open, the daily this valuation will be done. So generally what is done, it is not done on continuous basis. So it is generally, if you look in the Indian context, the market closes by 3:30 p.m. and the orders which are taken before 1 or 3 p.m. depending upon what is the type of the scheme, those are considered for that day. And after the market is closed, then the valuation of all the security is done, and this NAV is calculated, and which has been published in the AMC website by 8 p.m. So this is how the NAV calculation takes place. Now let's take an example. I'll just again just go by example how this is done. So for that basis, let's assume how a new fund is launched. We all know what new fund in a mutual fund scheme is called. It's called new fund offer. And now it is customarily fixed. Initially, it was a choice of the fund manager to price it at some other price, but now it has been fixed that whenever the new NFO will come, the starting unit price of that NFO will be rupees 10. Now, when the NFO will come, the AMC will market it, will aggressively market it, and ask people to invest in the scheme. It's a new scheme. It will go to the distributors, also get a higher margin in form of commission. So they are also very gaga about motivating investors to invest in this NFO. Should you invest in the NFO? We'll discuss that in another video, whether it's always advisable to invest in the NFO. But yes, at times when the first time the scheme is launched, it is called NFO, and NFOs are priced at rupees 10. So let's take an example. So let's assume that Mr. A, he invests rupees 5,000 in this NFO. So at a price of 10 rupees, he is allotted 500 units. Mr. B, he invests rupees 1 lakh in this NFO at a price of rupees 10 rupees per unit. He is get allotted 10,000 units. In this manner, many investors invest their money and buy units, and they're allotted initially in NFO the unit at a price of rupees 10. So that's the starting NAV. Let's assume that the fund which we are talking about is able to garner 100 crore. So if they're able to garner 100 crore through NFO, they must have sold 10 crore units at rupees 10. So they must have sold 10 crore units. Many ABs like this investors must have invested this at the price of rupees 10, and they must have garnered 100 crore rupees. Now, what will happen about this 100 crore rupees? But obvious, the fund manager must have predefined where this money will be invested. At the time of launching NFO, he must have clearly stated the objective of the scheme. But it is not like that today I get 100 crore rupees and from the very second day I make a portfolio. It takes time for a fund manager to build on the portfolio, and by that time the money is lying in the current account or in bank deposits. So depending upon the strategy which the fund manager adopts, over a period of time he builds upon the portfolio. Now, just for understanding purpose, just for clarification purpose and making a very simple understanding how NOV is calculated, what I have taken, let's assume this 100 crore rupees are invested in two companies. A portfolio comprises of two companies, Alpha Limited and Beta Limited. Again, I'm saying this is just an example. In reality, the mutual fund portfolio doesn't comprise of two companies. It comprises of 40, 50, 60 securities and companies like that. But just for simple understanding that how NAV is calculated, we are taking here that this 100 crore rupees has been invested in two companies, Alpha Limited and Beta Limited. How much? The 60 crore rupees invested in Alpha Limited and 40 crore rupees has been invested in Beta Limited. Alpha Limited share price was 100 rupees when the investment was made, and Beta Limited share price was rupees 200 when this 40 crore investment was made. So what happens? So in a portfolio, you have 60 lakh shares of Alpha Limited at the price of rupees 100, which makes 60 crore rupees investment in Alpha Limited, and you have 20 lakh shares at a price of rupees 200 per share of Beta Limited, which is a total investment of 40 CR, and therefore the entire 100 CR which the scheme has mobilized from the investors have been invested in these two companies. Now, but obvious, this as at the time of investment, the price of this share is 100 rupees and Beta 200 rupees. It keeps on changing on daily basis. So let's assume on one given day, the price of Alpha Limited jumps to 120 and price of Beta Limited was showing rupees 220. So if the Alpha Limited price is 120 and in the portfolio there are 60 lakh shares, the valuation of this particular Alpha Limited jumps to 72 crore rupees, and similarly Beta Limited the price jumps to rupees 220. Now you have 20 lakh shares at the price of rupees 220. The valuation of this part of the portfolio becomes 44 crore rupees, and if I add the value of both these portfolio, my market value of portfolio has jumped to 116 crore rupees. So this is on any given day when the valuation is taking place. Now this is not the entire story. Now let's assume there are some expenses which company is incurring. Now it is each regulator in each country has some pre-specified guidelines that how much money a scheme can incur in the schemes, how much amount of money. There's a ceiling which has been imposed. We'll discuss that ceiling at some other point. That in what is the ceiling in India? Let's assume that the company estimated that we will expenditure of rupees 500 crore for the entire year. Now, rupees 500 crore rupees of the entire year, it includes management fees, branch expenses, distribution expenses, NFO expenses, all these expenses. Now, these need to be amortized on daily basis. So, if I divide 500 crore on daily basis, I get 2 crore rupees per day. Now, 250 days means that is the number of days in which the market is working. So, it's not 365 days because markets are not opening all the 365 days. So it's NAV is declared only on those days when the markets are working. So I'm assuming so markets are working 250 days in a year. So on daily basis, it comes down to 2 CR. So the net asset, so the portfolio valuation was 116 CR, but you write off 2 crore rupees in expense, and this becomes your net asset. And then the formula which initially was mentioned, this actually is nothing. Um, if you look at this formula, this is a numerator part. So market value of all investment minus expenses. And I'm assuming that no change has happened in the number of units. Outstanding unit remains 10 crore rupees. So if I divide this 114 CR by this 10 crore rupees, I get NAV, which is 11.4 rupees per unit. That is, on that day, the NAV declared of the scheme will be 11.4 CR. Now, what does it mean? Mr. A, who has a portfolio of 500 units of the scheme, his portfolio valuation will be 500 unit multiplied by 11.4 rupees 5,700. And Mr. B, whose portfolio was comprising of 10,000 units multiplied by 11.4 will be 11 lakh 40,000 rupees. So this is how the NAV is estimated.